Welcome to this explainer. Today we're putting on our expert analyst hats for a rigorous, professional-grade investment audit of CONMED Corporation. Their ticker symbol is CNMD. We're going to pressure test this stock using the foundational frameworks of absolute legends, Warren Buffett, Peter Lynch, and Benjamin Graham. And then we'll cross-reference all of that with some forward-looking discounted cash flow models. So let's get right into it.
Okay, here's our roadmap for today. 1. A snapshot of CONMED. 2. The Buffett and Lynch lenses. 3. The Graham lens and intrinsic value. 4. A discounted cash flow valuation. 5. Some alternative valuation models. And finally, 6. Our synthesis and final recommendation.
Section 1. Snapshot. CONMED Corporation. Let's establish exactly who they are and where their financials currently stand.
So CONMED is a well-established player sitting right in the mid-tier of the medtech industry. They've got some really solid defensible niches in minimally invasive surgery and orthopedics. Looking at the raw data, they're pulling in about $1.37 billion in trailing revenue, and the stock's been trading right around $42.41. Now, they boast a pretty healthy 55% gross margin, but honestly, converting that top-line magic into actual bottom-line net profit, that's been their main struggle historically. But here is where it gets incredibly interesting. We aren't just looking at a static, boring company here. We are looking at an event-driven momentum play. The stock recently jumped 10.5% in after-hours trading because word got out that they're exploring a potential sale driven by some heavy private equity interest. You pair that buyout rumor with a brand new CFO stepping in to tighten up their financial execution, and wow, the immediate narrative around the stock has completely shifted overnight. Moving on to Section 2, the Buffett and Lynch lenses. Let's see how the greats would view this setup. We have to start with the Oracle of Omaha, right? Warren Buffett's framework is notoriously strict. He wants a wide economic moat, super consistent earnings, high return on equity, and a very manageable debt load. So, the big question, does CONMED pass Buffett's test at $42 a share? Well, it's a bit of a mixed bag for a value purist. Their economic moat is pretty narrow, and their profitability just sort of trails the best-in-class peers. Now, their debt is totally manageable. They have a debt-to-equity ratio of 0.85, but the return on equity sits at a really modest 5 to 6%, and that's well below Buffett's usual 15% threshold. With a razor-thin 4% net margin and historically choppy earnings, Buffett would probably pass on this one. But wait, we know Buffett loves to look at owner earnings to figure out the true cash-generating power of a business. We went ahead and calculated this straight from CONMED's cash flow statement. If you take their trailing 12-month net income of $54.85 million, add back the $74.87 million in non-cash depreciation and amortization, and then subtract the $18.92 million in capital expenditures, you landed an approximate owner earnings of about $110.8 million. So it's absolutely generating cash, it's just maybe not doing it with the supreme efficiency that Buffett demands. Now let's switch gears to the Peter Lynch lens, because here we find a stock caught in a really fascinating transition. Historically, because of those modest margins and thin profits, Lynch would instantly peg CONMED as a slow grower. But because of that active strategic review and the private equity buzz we just talked about, this stock has basically morphed overnight into an asset play or a turnaround. That one catalyst completely rewrites the entire investment thesis. To finish out our Lynch analysis, we have an assumption alert. Since forward growth rates aren't explicitly locked in right now because of that strategic review, we have to assume a 6% earnings growth rate based on management's top-end organic revenue guidance. Now, if we divide their PE ratio of 20.7 by that 6% growth, we get a PEG ratio of 3.45. For Peter Lynch, anything over 1.0 is getting pretty expensive. Toss in the typically high institutional ownership you see in mid-tier medtech, and Lynch would probably rate this a hold on fundamentals alone, just waiting to see if that turnaround actually materializes. Section 3, the Graham lens and intrinsic value. Let's look at the grandfather of value investing and run some hard math.
Running through Benjamin Graham's defensive investor checklist point by point reveals some real fundamental strength. It easily passes the adequate size test with over $1 billion in revenue. Strong finances? Yep. A 2.3 current ratio means they've got plenty of liquidity to cover short-term debts. Plus, they pay a consistent dividend. Where it trips up is earning stability. They actually had negative net income in 2022, and that PE of 20.7 is a bit rich for Graham's traditional 15x limit, even though the price to book is sitting at a very attractive 1.1.
Okay, here is the crucial math to find Graham's intrinsic value. Let's just treat this like a recipe. You take his famous base multiplier of 22.5. You multiply that by their annualized earnings per share of $3.56. Then multiply that by the book value per share of $32.09. Finally, you take the square root of that whole massive number. And what does that give us? It calculates out to a gram fair value of exactly $51.33. If we compare that to the current market price of $42.41, we're looking at roughly a 17% margin of safety. Now, Graham historically wanted a massive 30% to 50% margin, but let's be real. In today's highly valued market, a 17% discount on a company with solid liquidity, that might actually trigger a cautious buy signal for a modern value investor.
Section 4. Discounted cash flow valuation. It's time to leave the historical checklists behind and get into forward-looking math.
Quick assumption alert for you. A DCF model forces us to project the future. So to fill in the blanks from our data set, we're plugging in a weighted average cost of capital, or WACC, which is basically the required rate of return of 8.5%. We're also using a perpetual terminal growth rate of 2.5%. These are very standard conservative assumptions for a mid-tier medtech company operating in today's interest rate environment.
To build out this base case DCF, we have to forecast 5 years of free cash flows. We start with their actual trailing 12-month free cash flow base, which is $123.7 million. We project that outward using management's own 5% organic growth guidance. Then, we calculate the terminal value for the business at the end of year 5. And finally, we discount all of those future cash flows back to today's present value using that 8.5% WACC. Applying those standard industry assumptions, our DCF calculation lands on an approximate fair value of $50.55 per share. Honestly, it is pretty wild, and actually quite rare, that this purely forward-looking cash flow model lands within less than a single dollar of Benjamin Graham's historical asset-based formula. When two completely different valuation models align that closely, it's definitely a strong signal to pay attention to. But you have to remember that DCFs are incredibly sensitive to the inputs you choose. Just look at this sensitivity table. If you tweak the assumptions just slightly, like dropping the cost of capital down to 7.5% or bumping the terminal growth up to 3.5%, the fair value swings massively, from as low as $41.50 all the way up to $68.50. This is exactly why expert analysts never, ever rely on just one single valuation model. Which brings us to Section 5, Alternative Valuation Models. Let's cross-reference everything we've done so far to get the full picture. If we run a comparable company analysis and apply a conservative P/E multiple of 15x against their peers, we yield a price of around $53. Makes sense. But traditional EV/EBITDA models, which factor in their debt, pull that valuation down significantly. And most notably, BMO Capital Markets initiated coverage with a specific price target of just $36, pointing to earnings noise, tariffs, and refinancing overhangs. Just look at that massive spread between intrinsic mathematical value and current institutional sentiment.
Section 6, Synthesis and Final Recommendation. It is time to render all of these numbers together.
When we look at all the models side by side, it's fascinating. The pure mathematical intrinsic values, the Graham formula and the DCF, both screen by near $50, showing some real upside potential from the current $42 price tag. But the execution risks, those mixed Buffett and Lynch scores, and that very cautious $36 analyst target, they weigh heavily on the other side of the scale. Blending all of these insights, our final recommendation at $42.41 is a hold. The fundamentals are stable, sure, but they don't justify a full buy until the price drops closer to the mid-30s to create a genuine margin of safety against those very real execution risks. So I'll leave you with this provocative thought. When you look at CONMED today and you separate the noise of the headlines from the hard, objective numbers we just ran together, are you buying into a turnaround story fueled by a potential buyout? Or are you waiting for the fundamental math to actually catch up? Does this dynamic justify its current price in your portfolio? Thanks so much for joining this explainer, and remember to always keep testing those assumptions.